will talk about the smart beta strategy. The smart beta strategy seeks to combine the benefit of passive investment and advantage of active investment. So here is the graph. I will show you the ETF and active fund. So for the ETF, it's kind of a passive investment, and it will earn the market return. And all the ETF, they have the rule-based and transparent. So the rule-based means that all the strategy was open to all the investors. So if you are interested in, you can follow that strategy to construct your portfolio and directly follow that ETF or follow that market index. So that is the rule-based and the transparent. And the right-hand side is our active fund. That is the active investment. So passive and active. For the active investment fund, it could get active return. And for smart beta, it's in the middle of the passive and active investment. So on the one side, it can be the rule-based and transparent, and the transaction cost is much lower. But on the other side, it also can get some activity return. So that's the reason why recently smart beta strategy is very famous in China or in all of the world. So what's the smart beta? Smart beta strategy usually use alternative index construction rule to traditional market capitalization-based index. The traditional index, definitely they constructed their index based on market capitalization based, using the market capitalization as the weight for each individual stocks in the portfolio. But for the smart beta, it used the different strategy, and we use other weight compare with the market capitalization. The other ways, the alternative ways, might be based on volatility, liquidity, quality, value, size, or momentum. So based on different parts, we can construct different weight for our smart beta portfolio. And the second point is based on passive index investment, adding the logic of active investment stock selection and realizing effective exposure of specific risk factors through quantitative models. So in this smart beta strategy, we combine passive investment together with the active investment, and then we can earn the active return. And the smart beta are systematic investment strategy that aim to deliver higher return, lower risk, or more diversified performance in comparison to benchmark index. So in this graph, I will show you what's the smart beta strategy. So for the smart beta strategy, first you need to choose a benchmark index. If you choose one benchmark index, that index is constructed by market capitalization weight. We can do the weight optimization or the stock selection optimization. So there are three different ways you can construct your smart beta index. One way is you only change the weight of your portfolio opposite to the market capitalization weight. The second way is that you can only change the stock selection, if you follow S&P 500 as your benchmark index, you can choose 100 stocks from this 500 stocks. So that's the stock selection optimization. And the third way to construct your smart beta index is you can also change the weight optimization or the stock selection optimization together. So change the weight and also change the composition for the stocks. So using this weight optimization and stock selection optimization, we can earn the alpha return, which is our active return. So you can construct our smart beta index and then form our smart beta mutual fund. So that's the concept and how can we construct our smart beta strategy. Now we will compare the difference between smart beta, passive investment, and active investment. Now let's have a look. For passive investment strategy, the exposure to macroeconomic factors, both of them, these three strategies, they are high to exposure to macroeconomic factor. And for the exposure to stale factor, the passive is low, smart beta is moderate, and active is moderate. And the third one is potential outperformance. The passive investment strategy, definitely we won't have the outperformance. And for smart beta, it's moderate, but the active investment strategy, we will have the moderate to high, but we don't have the certainty about that. And the turnover and trading cost for passive strategy is the low trading cost and turnover, and smart beta is much low because it definitely it will tracking the benchmark, and based that benchmark we change the weight or change the stock in that benchmark. And for active investment, it's moderate to high. The liquidity and capacity, the passive is high, smart beta is high, and active is low to moderate. The last one is the transparency. The passive and smart beta are high transparency, and the active is low transparency. Now let's have a look at the smart beta strategy. So there are 4 different categories for the strategy, and the first one is called the one-factor strategy. And based on this one-factor strategy, and we can decide the weight or the selection, stock selection only based on only one factor. So these are the factors you can choose. Also the stale risk factor. And the second strategy is multi-factor strategy. This multi-factor strategy for smart beta is based on multi-factors together to decide which weight and which stock we need to select in our smart beta portfolio. So that's the multi-factor strategy. But recently, we find that one-factor strategy is more popular than multi-factor strategy. And especially in China, we have the dividend strategy for smart beta. So high dividend company will have a higher return. So lots of mutual funds follow that dividend strategy. And the third group is alternative weight strategy. Based on this alternative weighted strategy, we only change the weight for our smart beta portfolio. So we can, using the equally weighted strategy, take all the stocks in our portfolio giving the same weight, and finance data weight based on some financial data for each individual companies. We give the finance data weighted. And the last weight is called volatility weighted. So based on volatility, to minimize the volatility, we decide what's the weight for each individual stocks. The last group is quantitative strategy, and we might think about the behavioral finance, event arbitrage, and also the big data and technology strategy. So we discussed this before, and you can go back to the chapter 6 to have a look at the stale factor part. Now let me show you this graph to analyze the smart beta strategy and the risk management. The bottom of this one, you can see, is passive management and active management. The horizontal axis is your active risk and market risk. Now let's have a look. The first is your market index. This market index is generally the broad-based index, 宽基指数, such as SP 500 and SSE Composite Index. So using this market index doing beta strategy, definitely it has market risk, but never have the active risk, and this is a passive investment. So this is the beta strategy. And the next one is the style index. The style index is based on different style. We can construct the index. So definitely the example is Russell 1000. I have explained that before. You only choose top 1000 biggest market cap stocks in the portfolio. And also we have SSE 50 in Chinese market. So these are style index, and it is still the beta strategy, and also we have nearly passive investment and experience the market risk. And then we move to the middle. That's our smart beta strategy. For the smart beta strategy, we have different categories. As I mentioned, we have multi-factor strategy, alternative weighting strategy. This group are much lower active risk and more about in the middle of the passive and more about the passive. So we have different case in this group. And then we have the single factor and quantitative method, and this is more about the active investment. And the single factor part, definitely it have more risk because we only consider single factor, and we in the smart beta strategy we didn't change this factor, this strategy during the time period. So maybe some times, as I mentioned, this period we prefer the value stock, but the next period the growth stock works better, but in this strategy we won't change from value stock to the growth stock. So the risk for the single factor might be a little bit high. And the last part is our alpha strategy. So for the alpha strategy, definitely the highest active risk and for the active investment. So that's the graph to show you the beta strategy, smart beta strategy, and alpha strategy. Hope you understand that. Now I will show you a smart beta example. So this is the CSI 300 index from 2006 December to 2015 December, and all the data here. You can see the first index is CSI 300, and the annualized return from this time period is nearly 15%. And the second index is called CSI 300 eco-weighted. So in this index, we construct this index, give all these 300 stock the same weight, and we find this smart beta index has the annualized return is 18.53%. It's a little bit higher than CSI 300, the benchmark. And the third one is CSI 300 fundamental weighted, and then volatility weighted, eco-risk contribution weighted, sector eco-risk contribution, and the last one is high beta, which is to construct by the highest beta stock in this CSI 300 index. So all the smart beta strategy, they have a higher annualized return than the CSI 300. So let's have a look. The risk premium is always positive compared with CSI 300. In other words, our smart beta strategy will help you to earn an active return. However, this kind of smart beta index cannot directly buy in Chinese market. So different mutual fund companies, they construct their smart beta strategy. They have different smart beta mutual fund. So we can buy this mutual fund in the market. The last slide I will talk about is about enhanced index fund. It is a fund that seeks to enhance the return of an index by using active management to modify the weight of holding for additional return. So based on this enhanced index fund, the large part of our investment will go to the passive investment, to some market index, tracking some market index, and get our traditional beta. But only a small part of our investment doing some active investment to earn the alpha return. So that's the enhanced index fund. And in our country, we have some regulation that for the enhanced index fund, the total percent to invest for the active investment should not larger than 20%. In that case, we won't invest much more for active investment. So that's the enhanced index fund, and this fund has relatively high fee and turnover compared with the traditional index mutual fund. Okay, that's all for chapter 7. Now let's have summarize the chapter 7. And for this chapter, we talk about the portfolio management strategy. The first, we introduce the passive investment strategy. We introduce what's the passive portfolio management and what's the 3 different techniques for index portfolio construction, like full replication, sampling, and quadratic optimization. And then we introduce the tracking error, and the methods of index portfolio investing include index mutual fund and ETF. And the second part, we talk about the active investment strategy, and we told you what is the active portfolio management and what's the active return and active risk. And how can we doing the active management strategy based on fundamental, technical, or doing some market normalize or stale. And for the third part, we introduce the assets allocation. We first introduce the different asset classes, and then talk about the SAA, strategic assets allocation, and TAA, tactical assets allocation. And then we use one example to compare with SAA and TAA. And last, we compare the stock selection and market timing. And the last part for this chapter, we introduce the pure alpha and smart beta strategy. Both of these strategies are widely used in practical and in the mutual fund. So we introduce what's the alpha and what's the beta and what's the smart beta. And then we introduce the pure alpha strategy and smart beta strategy separately. So that's the whole chapter. So that's the end of chapter. Thank you so much.